Good afternoon, everybody. My name is Guy. Welcome to today's webinar. It's 1 p.m. in Abidjan. We'll give another minute to participants to join, and we'll start in about another minute or to 1:03. Thank you. My name is Guy, and we are today this webinar on recent trends in the banking sectors in Sub-Saharan Africa. I am the Research and Knowledge Manager with Making Finance Work for Africa. This webinar is the first of a series of 3 webinars jointly organized by us, Making Finance Work for Africa, and the European Investment Bank. And also the webinar is inspired by the EIB's flagship report titled Banking in Africa, Delivering on Financial Inclusion, Supporting Financial Stability. Before we get started, I know we have a lot to cover today with our 3 panelists. I would like to go over a few items, including the structure of this webinar, as well as important information and instructions on how to better participate in today's event. In terms of timing, this webinar will last 60 minutes, including the Q&A session. For your comfort, we request that all participants mute their microphone. If you have any question during the session, you can submit your question via one of the 2 panels on the chat or Q&A tab, or you can simply click on the raise hand icon. It's also important to let you know that you should always lower hand and mute your microphone after your question. And also feel free to send a message to the organizers for any issues. We have our colleague Mohamed ready for any technical issue or question. In case you are experiencing such issue, just also feel free to send a quick request for support, and we'll be more than happy to help. Finally, the slides and a recording of this presentation will be available after we conclude on our website, Making Finance Work for Africa. So the website is MFW4A.org. The report is also available on our website. The flagship report, EIB's flagship report on the banking sector in Africa, is available on Making Finance Work for Africa and on EIB's website. Also, please remember at the end of this webinar, remember to fill out the survey that will appear automatically after the session. This survey is really important to us, as it helps improve the delivery of our webinars and to identify relevant financial sector related topics to discuss. Thank you for filling out the survey. This ends our housekeeping. Before yielding to our panelists, I would like to give you a quick overview of Making Finance Work for Africa. It's basically a G8 partnership, a G8 initiative, launched in October 2007. Our mission is to serve as the reference platform for advocacy, knowledge sharing, and cooperation on financial sector development in Africa. So basically, most of the time, people ask, how do we do that? We do that by simply working on 3 interlinked strategic pillars, financial inclusion being one, the second one, long-term finance, and the third pillar is financial stability and regulation, with the research and knowledge management as a cross-cutting pillar. I have to say that Making Finance Work for Africa brings together donor partners, African governments, the private sector, and other financial sector stakeholders. Our funding members include the African Development Bank, the German Development Agency, GIZ, the French Development Agency, AFD, Minbuza, Afrexim Bank, and the European Investment Bank. Today we have three panelists. I'm going back to the slides. We have Jean-Philippe Stingst, senior economist with the European Investment Bank. Adeline Pelletier, she's a lecturer in strategy at the Institute of Management Studies, Goldsmith at the University of London. And Jared Osoro. Jared is a director of the KBA, Center for Research on Financial Markets and Policy. Remember to send your question at any time during the presentation. And after the panelist discussions, we'll collect all questions and address them during the Q&A session. I now welcome Jean-Philippe for his presentation. Jean-Philippe led the team of researchers and professionals who contributed to the report we'll be talking about today. Adeline and Jared obviously will follow with their takes on the subject, and we'll start our Q&A session in about 25 minutes. Jean-Philippe, you have the floor.
Thank you very much, Guy, and thank you for all participants for joining us today. Today, Adeline and I will kick off our panel by digging into some of the key results from our report on banking sectors in Africa, 2018 edition, and more specifically, some of the key results from a survey that we run on banking groups operating around the continent, and more specifically in Sub-Saharan Africa. Next slide, please. Our study was launched on the 22nd of November in Addis Ababa in partnership with UNIDO this year, and it's available in English and French, including on our website. It's very easy to Google, so I'm sure you'll find it, and I know it's linked from Making Finance Works for Africa's website as well. Next slide, please. Let me start by discussing the results from questions we've put to the 25 banking groups that were surveyed for our 2018 editions, and compare those results with the previous edition, full edition of our study, which was published in 2016. Basically, we asked banking groups operating in the region what was their main strategic focus going forward. And interestingly, SMEs came out on top with, in this edition, 60% of respondents identifying as the most important of their strategic focus going forward. The other striking area of focus is retail clients. And taken together, we interpret those results as saying that banks are under, thanks to rising competition, are increasingly prodded to step out of their comfort zone and increasingly refinance clients that used to lie outside their preferred space or niche, specifically SMEs. And as SMEs require loans in local currency, it is therefore not surprising at the same moment that banks have put an increasing focus on raising resources in local currency and therefore on attracting deposits from retail clients, which have increased markedly in terms of focus by banking groups between the 2016 and 2017 edition of our survey. The flip side of this is that at the margin, obviously, large local companies and large multinationals have faded out in terms of focus for large banking groups. We don't take that to say that those banking groups do not care about those clients anymore, but that it's not their focus at the margin in terms of growth areas and strategic focus. Next slide, please. This is another question we've put to banking groups, and here what we've asked them is, what do they consider as the most relevant, most important obstacle to their deploying further credit to SMEs? The number one cited obstacle was the lack of reliable collateral. And the next one was the high default rate amongst SMEs. So altogether, these two obstacles cover about 2/3 of the answers from the banking groups that have answered our survey. And we take that as evidence that guarantees, portfolio guarantees, which would help banking groups hedge the credit risk associated with SMEs, would help unlock, at least partially, credit to SMEs. And I'll return to that point in my next slide, but don't flip it yet, because I want to mention managerial capacity as corresponding to 17% of responses from banking group, and we think that's an important message as well. We believe that stimulating the growth and the expansion of SMEs is more than about just providing lines of credit. Improving managerial capacity amongst SMEs and improving banks' ability to process their credit applications would also go a long way. And finally, other relevant answers that came up include lack of information, costly monitoring, lack of reliable credit reference bureaus, and these are all areas that we're also concerned at EIB, amongst other development partners, obviously, and that we contribute to via contributions to funds by the IMF that help subsidize, for instance, technical assistance activities in the banking sectors from AfriTech Technical Assistance Centers, amongst other initiatives. Next slide, please. So in this slide, we're reporting the results from asking banks whether they think that their needs for credit guarantees for SMEs are have been met or not. And one could see the SPY as indicating that the glass is either half full or half empty. It is half full because 45% of banking group report their needs for credit guarantees as being met, but it's certainly at least half empty because the other half, the groups, report their needs for credit guarantees to be either largely unmet or partially met. And we take this as a further indication, linking back to our previous slide, that there's an unaddressed demand for credit guarantees, and that if we could, FIs and DFIs and other players in this space, could work on more better priced, more effective, and more efficient products in terms of portfolio guarantees, this probably would be of significant help towards improving access to finance for SMEs. Next slide, please. This slide reports the results of asking banks whether they think that the demand for loans for local currency, USD, Euro, or other emerging market currencies is either in line or stronger or below market trends. And the most striking results is that banks report that demands for loans in local currency is either in line or stronger than market trends. And we take this as indicative that our efforts to deploy credit lines to banks for on lending in local currency, so we synthetically offer a hedge against currency risk with some of our lines at EIB upon demand from clients, are meeting strong demand. So this is complementary to the feedback we get directly from our clients, and indicative that this is an area where IFIs like us have further to go in terms of contributing to local demand. Obviously, if we want to finance SMEs with revenue streams mainly in local currency, it only makes sense that we provide the corresponding resources to local banks so that we don't force them or incentivize them to have a currency mismatch on their balance sheet. Next slide, please. So I've been asked to keep my intervention relatively brief, so we leave a lot of space for other panelists and for your question and for answering your questions. So let me just quickly wrap up our main conclusions. We think there's rising competition amongst banks, and that this is why banks are being forced to step out of their comfort zone and are increasingly considering SME lending with the seriousness that it requires. We also pick up rising demand for local currency lending. We also found that there's unmet needs for portfolio guarantees, and we think that both of these are interesting options and valuable options for IFIs in terms of further contributing to financial development and access to finance for SMEs. We also find reports in our study that financial inclusion is rising, but it still has a long way to go. But I will let Adeline speak more to that. Next slide. And to finish, I'd like to identify a few challenges. As banks increasingly rely on the current retail client deposits, we have to be aware that we are exposing first-time depositors to the risk of these banks having a bank run, to speak plainly. And we certainly want to avoid this because it took a lot of time to restore trust in the banking systems amongst these clients, and we don't want to scare them away. This is a plea for taking financial stability seriously. Second, we've also picked up a rising share of non-performing loans in most of banking sectors across the region. And we think here too, we need to apply the required amounts of prudence. A bank that is bankrupt or illiquid is not a bank that lends. So we need to make sure that banks in the regions remain healthy, and all the more as they are stepping out of the comfort zone and taking more risks on SMEs as we would like them to. And finally, I'd like to reiterate that we think that there's more to SME lending than just credit lines. We also think it's important to build capacity with banks, but also with our clients, and that is certainly something that we like to do at EIB. We have set up a Bankers Academy in Southern, Eastern, and now Western Africa, and are programming further efforts to increase capacity in this sector. Without further ado, I'd like to hand it over to Adeline, who is my co-author for this chapter. I'd just like to briefly mention that all of our chapters have been co-authored with external co-authors, and there's a good reason for that. We like to make sure that whatever we're thinking is grounded either in serious academic research or backed up by what people in university circles think, or that people on the ground and practitioners on the client side also think. So this is my opportunity to extend my gratefulness to Adeline for helping me with the survey and all of our contributors to our survey, to our study. Adeline, the floor is yours.
Thank you, Jean-Philippe. Thanks. So I'm going to cover with you today some indicators and trends of financial inclusion and linking them to our survey results from the banks. So if we can go to the next slide. Perfect. So here on this slide, I want to show the rapid improvement in financial access. And part of this improvement is actually due to the fast penetration of mobile payment services. So if we look at the table, we see that the percentage of the population that has access to an account in 2017 in Sub-Saharan Africa is 43%, up from 23% in 2011. But actually, account, as defined by Global Findex, includes both financial institution account and mobile money account. So actually, part of this increase is due to the increase in mobile money accounts. The other thing that I want to mention is that bank account ownership is still much lower than the average for developing countries, which was at 63% in 2017. So when we look at the banking sector per se, we see the low number of adults with access to a savings account, and also the low number of adults with access to a debit card. Actually, another thing that is important to note is that around a third of Sub-Saharan African adults borrowed from family or friends in 2017, which showed the still very important part of the informal sector. At the same time, this number is down from 40% in 2011, which also shows the improvement, again, partly related to the fast increase in the penetration of mobile payment services. So we can go to the next slide. Thank you. So in this slide, we note that Sub-Saharan Africa is the region of the world that has the largest deployment of mobile payment services, with 135 mobile payment providers or services in total over the region. We are all familiar with the M-Pesa story. I think the thing that is important to mention with regard to Sub-Saharan Africa is the fact that most of it is really telco-led. The regulators have allowed telco to play in this area, to basically be able to provide this type of services. And now we see also the emergence of new products. So mobile money providers are also doing microloans and saving products. A good example is M-Shwari, which was started in 2012 and is a partnership between CBA Bank and Safaricom, and around 20% of Kenyans are now active M-Shwari customers. The other thing that I want to mention is actually related to this example of M-Shwari is the importance of strategic partnerships between banks and telcos. In fact, in our survey, 78% of the banks say that telcos and banks can form effective partnerships, and only 17% consider that telcos were actually direct competitors. There are several advantages to telco banks partnerships. So on the one hand, if a telco partner with a bank, it can offer more products beyond just a simple mobile money account. They can offer loans, products, savings products via the mobile phone. It's also a good way to integrate more economic transactions into the formal system, which then generates major benefits in terms of economic development and growth. And obviously, given the high cost of brick and mortar approach for banks in countries like Sub-Saharan African countries, due to the low level of infrastructure and sparse population, partnering with a telco is also a good way for banks to get access to the local population via the large retail network of telcos. So for banks, the mobile money business is actually a departure from their traditional business, which is based on fees from intermediation. That said, we find that some banking groups are actually among the top providers of mobile money services. An example is First Round Bank in South Africa, which provides mobile money services to several countries in the southern part of Africa. We asked the banks what were the key focus, and actually in our survey they answered that most of them actually focus mainly on internet banking technology. 42% of them have said that they have their internet banking technology fully deployed, and concerning mobile banking, 25% of our surveyed banks said that they have their mobile banking technology fully deployed. We can now go on to the next slide. So let's have a look at the use of digital and mobile payment services in Sub-Saharan Africa. So we observed that a little bit more than a third of the population have made or received digital payments in the past year, so up from 27% in 2014. So other interesting number is the fact that 23% actually paid utility bills via mobile account, and 19% of the population received wage through mobile account, which shows actually the ways in which mobile money is actually transforming economic lives in Africa. And it shows as well the fact that mobile money is an efficient and affordable way to conduct transactions, not only payments, but also in terms of paying bills and receiving wages. So we can now move on to the next slide. So let's focus now on the banking sector. So this table shows few figures related to the progression of the banking sector over the last few years. So it shows signs of progressions, but from low levels of penetration. So there's a slight increase in the number of commercial bank branches from 3.7 bank branches per 100,000 adults in 2012 to 5.3 in 2016. That say, this number are still well below the average for developing countries. The number of borrowers and depositors is also increasing over the period, but again, still below the average for developing countries. So to conclude my presentation, I think we can see that there's still real opportunity for mobile money services to expand further and fill in the gap. Thank you.
Let me just say a word of introduction. Thank you, Adeline, first of all. And let me just say a word of introduction to what comes next. Jared is a long-time partner of our study, so we're very, very grateful for his contribution and the commitment of the Kenyan Bankers Association to our study. It is through partnerships like this that we can ensure that we're relevant, that what we say is of high quality and is consistent with what happens locally. So obviously the first, in all frankness, the first purpose of our study is to inform our own operations. We need to know the countries and the markets where we invest, but we want to be sure that we're on target. And the best way to do this is to work with great researchers like Jared Osoro. Without further ado, Jared, please tell us more about the Eastern African market.
Yeah, thank you, Jean-Philippe, for the kind words. I think mine is really to say that from the context of East Africa, what we see from the ground is that the survey findings are really aligned to many of the things that we see in the market. In the sense that over time, we've seen the attitude of the banking industry and the financial sector largely changing in a manner that's favorable to lending to SMEs in Kenya and in the broader East Africa. So if you look at how important the SMEs are in East Africa, you'll appreciate that in many respects, they have become a very critical component of the economy. In Kenya, for instance, they estimate that approximately 75% of all enterprises can be classified as micro, small, and medium enterprises, and therefore their role insofar as the performance of the economy is absolutely critical. And linked to that, of course, is the more important they are, the more critical they become insofar as the demand for financing of their operations. And that is why we've seen over time a number of financial institutions adjusting their strategic orientation with a view to ensuring that they understand the operations of SMEs and therefore operate in a manner that is able to meet their needs. What we've tended to see over time is that if you look at the Kenyan market, for instance, over the past 10 or so years, many of the financial institutions have oriented themselves through expanding their branch network in a manner that enables them to serve the SME clientele across the country. And that has not only reflected itself in their portfolio allocation, which has increased over time insofar as lending to SMEs is concerned, but they have also tried to operate in a manner that ensures that the SMEs support the growth initiatives. So the funding and the capacity enhancement partnerships that we've seen banks build over time is really geared towards ensuring that they understand the needs of the SMEs and they support the SME growth from the context of both working capital needs as well as investing resources insofar as enabling the expansion is concerned. So in that respect, we see SMEs as being a very, very critical component, not just for the purpose of the growth of the regional economy in East Africa, but insofar as enabling the growth in the financial sector that then goes to support the growth of the SMEs. One unique characteristic that we see in East Africa, and I think you can say that in a number of other regions, is the fact that a number of our banking industry players have started looking at the region as a market. So some of them actually do cross-border expansions on the basis of looking for SME opportunities that are existing in the region, but a number of them actually take advantage of the SMEs themselves looking at the region as their market. For instance, we have a number of Kenyan SMEs that have taken advantage of the regional integration arrangement under the EAC to expand across the region, and this has tended to inform banks that are looking at having a regional footprint, moving across borders so that they can continue serving those SMEs. And another characteristic of these regional orientation of banks is that it's not just the big banks that are moving across borders, implying therefore that the banks that have economies of scale wanting to enhance that and moving across the borders. We have a number of smaller banks, small and medium-sized banks, that are actually moving across borders with a view to using that as a platform to enhancing the economies of scale. But given the typical characteristics of the enterprises in the region being SME, you can therefore argue that the regional expansion of banks is basically geared towards ensuring that they support the SMEs both locally and regionally. If you can move to the next slide, please. Now, in the Kenyan landscape that is largely bank-led, we've seen a number of developments insofar as the financial inclusion agenda is concerned. And some of the issues actually have been mentioned very eloquently by Adlan in our presentation. But what we tended to see is that as the banks embrace partnerships with mobile network operators and therefore bring formality insofar as the offering of financial services is concerned, the informal financial operations actually are declining over time, meaning therefore that the partnerships that banks are establishing with mobile network operators is increasingly proving to be very vital insofar as ensuring that we move access to financial services by SMEs from the informal, which tends to be a bit expensive, to much formal financial provisions. But beyond access, what we are tending to see in the market is that access is important, yes. And we see access coming in respect of the branch network and taking advantage of agency banking that has been embraced not just in Kenya but regionally as a necessary condition, but hardly sufficient unless now we start enhancing the usage of the financial services. So the examples such as the M-Shwari that was given earlier is basically one of the mechanisms in which usage of financial services has been enhanced, and therefore translating the payments that has been enabled by mobile network operators into now the intermediation space where now SMEs and households are able to use the mobile infrastructure to do intermediation in the form of savings, mobilization, and also credit provision. So we see access as the first step, but most importantly, we see enhancement of usage of financial services as a very critical component of this journey of financial inclusion. And the partnerships that we are seeing therefore means that technology is increasingly becoming very critical insofar as the offering of financial services is concerned. And this actually has started to manifest itself in a manner that the expansion in brick and mortar is not as fast as it has been in the recent past, because now investment in technology has been considered to be a much more cost-effective way of supporting financial inclusion through SMEs. And On the back of that, I think the SMEs and the lenders have had to do what one could call a balancing act, which can be seen in three respects. One respect is really balancing between the cost of financial services and access. Because sometimes people may be very, very sensitive to the cost aspect at the expense of constraining access to financial services. So that's one area in which we are seeing an element of balancing act. The other is really the consideration between local currency requirements vis-a-vis hard currency or foreign currency requirements. And this really is a function of the nature of SME that is operating in the market, because some of the SMEs are basically domestic market leaning, and therefore the resource requirement is typically in local currency. And I think the survey, as Jean-Philippe mentioned, points to those SMEs requiring substantially their resources in local currency. But those that have an opportunity of operating across borders, especially in East Africa, have an opportunity of accessing resources in hard currency. And some of those resources are actually availed through partnerships that the banking network in the region is building with a number of international DFIs. And I think a novelty is that a number of the international DFIs, particularly the African Development Bank, has been looking at promoting a long-term resource mobilization in local currency through, for instance, the issuance of local currency bonds in the market where they operate. So that's an opportunity for not only availing resources, but availing resources in the currencies that are important. Now, the other is really looking at complementing credit and equity. So just to wrap up, I just need to mention a number of attributes that tend to inhibit or constrain SMEs insofar as access to funding is concerned. One of which, of course, is that many of them are really informal, where it's very difficult to separate an entity as a business from the promoters who are households. And that feeds into the information gap that Jean-Philippe alluded to earlier. And then, of course, a number of enterprises, especially in agribusiness, are grossly undercapitalized, and that tends to constrain the ability to raise sufficient resources for purposes of enabling them expand their businesses. And of course, the other one which I've pointed out earlier is that many of them are really in the non-tradable space, meaning that they are basically looking at supporting or the local currency requirements because of the nature of the market. They basically have the local market, and therefore the resource requirements that they have essentially in local currency. So when, for instance, lines of credit are availed in hard currency, that may not necessarily be very amenable to this kind of SME. And then, of course, in the Kenyan case in particular, in an endeavor to ensure that the cost of credit is addressed, we've had an episode of distortionary interest rate control, which has tended to negate some of the gains that we've had insofar as financial inclusion is concerned in the Kenyan context. Because now we've seen instances where banks are not able to lend to SMEs because they're not able to appropriately price the risks that are associated with lending to SMEs. So broadly speaking, those are the perspectives that I can give from East Africa. And I think in a large way, gelling very broadly with what we're seeing in the survey that EIB has been conducting over time. Thank you very much.
Thank you, Jared. We're going to jump right away into the Q&A session. And I'm going to start by asking a quick question before I can turn to our participants. I know we have a couple of interesting questions so far. This question is for Jean-Philippe. In terms of scope, what do you think quickly has changed? I know in 2016 you had another report. What in this report is different compared to the 2016 edition? Jean-Philippe?
Thank you, Guy. With every edition, we try and stretch the boundaries on what we do and improve the quality of our contribution. And between these two major editions, we had an interim report in 2017 about digital financial inclusion in Sub-Saharan Africa. But between the full 2016 and the 2018 editions, we basically increased the geographical coverage from Sub-Saharan Africa to Africa as a whole, as a continent. We're very proud about that, and we intend to go on with this expansion so that we provide something that reflects the increasingly integrated nature of banking sectors and banking groups across the continent. Indeed, the other improvement that we've managed is to expand the number of banking groups that our survey covers from 20 to 25. And the many other things, but including, for instance, the fact that we've split. We used to have a chapter that covered both Western and Central Africa, and we thought that was unfair to the differentiated challenges and opportunities that both regions / zones offer. So now we have a separate chapter for each sub-region. That's about it.
Thank you, Jean-Philippe. I think before I move to Adeline, I think you received also a question from Arthur Minsat. Can you please answer his question from OECD about size in terms of productivity? Should bank focus on big or small companies? Can you answer this question before we turn to Adeline?
Sure. Let me scroll back to Arthur's question and invite all participants to interact with us this way using the Q&A tab in the WebEx window. So the question is, how can banking sector help African firms catch up with the global productivity frontier? And specifically, does firm size matter for productivity? Well, I think that's certainly an excellent question. Our survey doesn't necessarily address it directly. We don't necessarily, productivity is certainly one element that we take into consideration in considering the impact of our lending activity. But that's certainly not the only one either. In terms of mandate, EIB has for mandate within the context of the Cotonou Agreement in its investment facility to broadly contribute to the private sector development on the one hand and financial sector development as well. So we see those objectives as very broadly, and we also care about employment, competitiveness, etc. More specifically, there is evidence in the literature that size does matter, and that this is also why very small firms tend not to be exporting or exporters. But that's not necessarily a reason to exclude them. To the extent they contribute to local employment and to inclusive growth, we think we need to deploy a constructive schizophrenia, meaning that it's not an either-or proposition. We think it's important to both refinance medium-sized, export-oriented firms, especially those that add value, and smaller local firms that provide livelihood and employment to local communities. We don't see that in either. We try and achieve both wherever we can. And the other question from Arthur from the OECD Development Center was whether questions keeps being added, so my window is scrolling. I'm trying to whether, according to our survey, productivity and jobs creation are meaningful lending criteria by the banks we surveyed. Here we're talking about private sector lending. So the banks that we intermediate with look at the criteria that commercial banks would naturally take into consideration, which is first and foremost, the financial viability of the loans that they give. And we certainly want to keep it that way to some extent, because we want to establish long-term, financially sound partnership with our clients. We want to lend to banks that are still in business years down the road. Having said that, good banking is about evaluating also the economic viability and the economic meaningfulness of investment projects. Every local banker that I've met with on appraisal missions and on research missions is passionate about developing his country's private sector, and I haven't felt quite a lot of cynicism amongst the SME bankers I've met in the region. So I'm pretty convinced that they care a lot about productivity, employment growth, and contribution to the local economic ecosystem. Only that they have to do that from a private sector perspective, i.e. at the end of the day, those loans have to be repaid, at least most of the time. Otherwise, we're looking at rising NPLs and eventually financial instability. So let me keep my answers to that at the moment. I've already been quite long. Sorry.
Thank you, Jean-Philippe. Thank you. I would like to turn quickly to Adeline. Adeline, you are the financial inclusion expert on this panel, and what brings you to conclude in your report that financial inclusion still has a long way to go in Sub-Saharan Africa, and what makes you believe it will be necessarily a good thing that the depth of banking sectors in Sub-Saharan Africa increases further? This question, if you can quickly answer this question, because I think we have a lot of questions from our participants. Thank you.
Thank you, Guy. I'll be very brief. So on the first point, so it still has a long way to go because large part of the population is still not banked. So obviously there has been some progress with mobile money, but when you look at the average, the number that I showed, the average for developing countries, it is still well below. And I will add to that. So even though a large part of the population may have access to mobile money services, in many cases, it doesn't extend to borrowing or saving accounts. And the second part of your question was the depth of banking sector and its importance for development. Well, I think in one hand, if you increase financial inclusion at the individual level, you can save more, borrow more, smooth consumption. So population can basically lead more fruitful economic lives, I would say. At the macroeconomic level, by basically concentrating more deposits, you should have positive effects in terms of lending, investment, and GDP growth. So that's why you need to have also further depth of the banking sector in Sub-Saharan Africa. I think in the future, it's going to come from a combination of banking sector with mobile money types of products.
Thank you, Adeline. I would like to stay with you. I have a question from Noji. She works with Atlas Mara. Her question is on the banking sector and telcos, to the point around banks taking the backseat and allowing, therefore, telcos to take the driving seat in mobile banking services. She's asked if it will be fair to say that as certain economies become mobile banking driven, that telcos will replace ultimately banks. That's a question for you, Adeline.
Well, I think there's a lot of regulatory issues around that. I don't think that telco would replace banks in the sense that you still need specific license for a lot of activities that can only be conducted by banks. But what might happen is that you would have telco basically taking on some activities that are not well provided by banks, especially related to difficulty to have a brick and mortar approach. And for products like, for instance, debit card, there's a real question as to whether this will actually develop as much as we see it in Europe, because now with mobile phones, there are lots of things that you can do in terms of payments, which then you don't need basically to have a debit card. So I don't think that we will see telco replacing banks, but we might see them taking on some activities that are so far not very well provided by banks in the context of Sub-Saharan Africa.
Thank you, Adeline. Let's turn now to Jared. Jared, I have a question on government borrowings. I know government borrowings has been a problem for in terms of crowding out the private sector. Have you seen any change with banks' exposure from government debt during your survey or during your own observations? And what do you think can be done from a regulatory standpoint to reverse this trend? Jared?
Yeah, thank you. I think reading through the survey, I think that's not an issue that has been explicitly tackled, but I think given the observations that I can make from the East African market over the period, we have seen the governments in East Africa, and in particular in Kenya, expanding the extent to which they come to the market, meaning the expansionary fiscal policies that the governments have undertaken over time on the back of revenues not increasing that fast simply means that they are resorting to the domestic market for purpose of borrowing to fill the budgetary resource requirements. What's clear, at least in the context of Kenya, is that has happened on the back of credit expansion to the private sector declining drastically over time. So as the credit growth to the private sector decline, banks are increasingly putting their resources to government paper. So essentially, that's a clear evidence of crowding out that has been happening over time. What has tended to occasion that, particularly in the case of Kenya, is a situation where you have interest rate capping that has not allowed banks to price risks and therefore look at the government as an avenue to investing, and that has manifested itself in the returns of banks. Even on the back of them not lending substantially to the private sector, their returns have remained favorably attractive over time. So I think what has tended to happen is that now there are discussions, actually interestingly emanating from the legislature, on how they can address the issue of interest rate controls with a view to enabling the government ease some of the resources that it's taking from the market and therefore crowding out the private sector. So that's one aspect. The other aspect is that over time we've seen NPLs increase, especially in the Kenyan market. So with NPLs now moving from as low as 5% of the gross portfolio to around 12% right now, banks are changing their risk attitude, and therefore they are more keen to lending to government than to lend to the private sector. So taking a combination of all those, we are now seeing a situation where the government is taking serious measures to do what they call fiscal consolidation, meaning rationalizing their budgets in a manner that makes them move away from taking resources that could otherwise go to the private sector. So in that respect, the clear evidence we are seeing of crowding out is likely to occasion or put more impetus on the government to radically look at its fiscal programs and therefore start moving away from taking resources that could otherwise go to SMEs.
Thank you, Jared. I have a question on regulation, and this is for our panelists. It's the same question as Idris Ahmed from Agence Ecofin and another participant. It's on regulatory framework and the current changes. Basel 2 and Basel 3 rules are being implemented in most countries. What do you think will be the effect, the impact of those regulatory changes in SME lending in the region? Someone would like to start, maybe Philip? Do you want to take a stab at this question?
Sure. I may not have the last word on it. I think it's an ongoing debate, but there's certainly a couple of things that we can say based on our survey. One is about compliance of, as reported by banking groups that have reported to us, banks' compliance with the Basel framework. So we have about almost all banks replying to be fully compliant with Basel I, obviously. As far as Basel II is concerned, we have basically 2/3 reporting being compliant, and another third reporting working towards compliance. As far as Basel III is concerned, we have 1/3 reporting to be compliant, 41% reporting to be working towards compliance, and 27% who don't think that it's an immediate priority. And that I think in this respect, there's always been two schools that I can think of and that are relevant here. One says that all banking sectors and their regulators should be making steady progress as far as they can and as fast as they can, just to caricature that school maybe a little bit, towards compliance with Basel III as an ideal. And there's another school that says, wait a minute, all these banking sectors come in different shapes and sizes. They have different stages of development, they're characterized by different needs, and so on. Why don't we rather let them pick and choose elements of Basel II and III, to be specific, that answer more closely their needs? And while I won't attempt to resolve this debate here, I think there are elements of wisdom in both approaches. One thing that we certainly believe at EIB is that the local context has to be taken into consideration. And the banking regulation and supervision has to adapt to local circumstances and the pace at which one can reasonably expect banks to adapt their capacity and take on new requirements from a regulatory and supervisory perspective meaningfully. So I don't think personally we need to think of banking supervision and regulation as being at a trade-off with SME lending. Obviously, a poorly regulated and unstable and uncreditworthy banking sector is not going to be very conducive to SME lending. Possibly an overregulated and with another banking sector that's facing an overbearing supervisory authority is probably not good for SME banking as well. I mean, that's true all over the world, and it's true in Africa as well. And obviously, balancing the pace and the degree and type of regulation in the banking sector is an art. That's why we keenly rely on our partners in Afritech Technical Assistance Center for this, and we very much value their advising and technical assistance to local governments. And the EIB has renewed its financial commitments to Africa Tech Centers in Sub-Saharan Africa.
Thank you, Jean-Philippe. I have a question from Maraki Decker from AFC, and I think this question is about non-performing loans. I think we went to Nairobi a couple of months ago where we discussed those same issues. It's about tech-based lending and the assumption that they lead to higher NPLs. Aside from low level of financial literacy, what do you think are the main underlying reasons, and how do you think we can circumvent those NPLs, those high level of NPLs?
I've spoken a lot, Guy. I would like to see and hear Jared's thoughts on that. I didn't thought about this, otherwise I'm bringing my own, but I think they would nicely complement what I said.
Sure.
I think did I miss the question? Because I think I must have missed the question. What's the question again?
So it's on the tech-based lending, the assumption or the fact that they lead to higher NPLs. What could be the reasons?
I think the evidence we have seen from tech-based lending is an increase in the number of NPLs. At least that's what the numbers that we have from the Central Bank of Kenya indicate. The reasons could be threefold. One of which is that many of the tech-based lending are essentially not based on a relationship like the normal conventional lending, and therefore when you're lending somebody on the basis of a history of either how they use their mobile financial services, you may actually find yourself leading into into a non-performing asset. That's one that I think has been brought out as a reason why tech-based lending has led to increased non-performing loans. The second is that many of those tech-based lending could actually be going into consumption, while the assumption is that they probably are going into businesses. So the increase in non-performing loans on account of technology-based lending is where the resources which are fungible are actually diverted and therefore leading into the business that are actually borrowing, if they're SMEs, not actually getting those resources, as opposed to a case where if it's conventional lending, the resources are appropriately targeted towards the use that they were intended to in the first place. So I think those are some of the emerging reasons, but I think it's an area that we need to delve into in a much deeper way to understand why that's the case. Because if you look at the level of non-performing loans in Kenya, for instance, the contribution of tech-based lending is very small because the quantum of the loans from that segment is still low. But the extent of non-performance of the loans that are tech-based is high, and therefore, as that component increases, we need to understand deeply what occasions that. But I think, in a nutshell, that's really what I can attribute to that particular observation.
Thank you so much.
Okay, thank you. Yes, I was saying that we went to Nairobi and we had a financial sector dialogue in Nairobi, and in fact, low literacy level was pointed out as one of the main reasons for these as well. So thank you, Jared, for your contribution. I know we're running out of time, but before we wrap up, I would like just to ask a quick question on one of your line, one of your main assertion in the report. You said that financing is not enough for private sector development, and you also suggested that technical assistance and knowledge transfers be to financing to sustain private sector development. I know you also spoke earlier, Jean-Philippe, about the need for MFIs and DFI to support the banking sector through portfolio guarantees and other products. Can you tell us more about this idea and the role that development partners can play in this regard?
But it's a fairly unsophisticated idea, but it doesn't make it necessarily less relevant. It's the idea that while banks right now are, as we've argued, stepping out of their comfort zone and building up their SME lending departments, that's certainly something we see whenever we go on appraisal missions and meet with clients. We see that we've moved from having an SME lending strategy to have an SME lending department. So banks are becoming ever more serious in the region about SME lending. They're still cherry pickers. Let's be honest and frank here. They finance the most financially sustainable SMEs that are in the market for a loan. I mean, these are beautiful firms, but if we really want to be transformative, all IFIs, DFIs will have to find ways to expand the share of SMEs that qualify, that are bankable, that qualify for bank loans. And that will take, in our views, significant efforts to contribute, at least at the margin, towards the formalization of firms, towards the ability of entrepreneurs to write a bankable business plan and of speaking a language that SME bankers understand. Vice versa, there's also a lot of value, in our view, in training bankers to correctly assess the creditworthiness of SME borrowers. Now, this is improving on its own, but our experience is that we also make a valuable contribution when we provide technical assistance to bankers and banks themselves, because it can tip the balance from making SME financing an interesting to being a profitable activity, and we like to tip the scales that way. I'd like to go back to the previous question that Jared answered very skillfully, and just to add a little point from my own here. As far as fintechs are concerned, one question in our view, is whether they're delivering on the promises based on which we all find them exciting, i.e., when they use alternative criteria for establishing the creditworthiness of, let's say, micro and small enterprises. Are they providing something that's revolutionary and therefore genuinely disruptive, or are they just lowering credit rating standards? If it's the former, then we can expect them to be able to actually possibly even lower non-performing loans as a percentage of gross loans. Why? Because they would provide an expansion of the portfolio of banks whose risk is decorrelated with the existing portfolio. However, if all they're doing is bypassing the good judgment of human bankers and finding ways of approving or green-lighting loans that wouldn't have been green-lighted using existing traditional approval systems, then we're providing possibly more riskier loans. But I think that's what it is also about. It's not just fintech in general, but what quality of fintech are we talking about? And as the craze starts to abate a little bit, and we're moving to phase 2 where fintech is actually being deployed, I think we're going to see being able to tease out the good from the not so good. That's what I would add to Jared's earlier answer. Over to you, back to you, Guy. And thank you, everyone, by the way, for excellent questions. I hope that we've provided you with valuable answers, but we'll also take good notes and we'll try to delve deeper into them in the 2019 edition of our study of banking sectors.
Thank you so much, Jean-Philippe. Thank you to our participants. I think we got several more questions, but for sake of time, we'll have to wrap up now. What we'll do is we'll send the question list to our panelists, and they will respond to those questions, to those unanswered questions, and we'll share it with all participants. I think as soon as possible. Thank you again, Jean-Philippe. Jean-Philippe is senior economist with the European Investment Bank. Thank you to Adeline Pelletier, lecturer in strategy at the University of London. And thank you also to Jared Osoro. Jared is the director of the Kenyan Banking Association Center for Research on Financial Markets and Policy. Before we close this event, one quick announcement. We'll have our next webinar on February 7th, and the webinar will discuss financing Africa green economy through Islamic finance. This is an important topic. Thank you everyone for attending our webinars. Thank you to our panelists. EIB's report, again, is available on the European Investment Bank's website and on our website, MFW4A.org. Feel free to get a free copy. If you have any other questions, please send us an email. Our email address is secretariat@mfw4a.org. Once the webinar ends, please don't forget to answer the questions on the survey. We greatly appreciate your feedback. And you also receive a follow-up email within 24 to 48 hours with a link to view a recording of today's webinar. On behalf of Making Finance for Africa and the European Investment Bank, thank you for joining us today, and see you next month. Bye-bye.
Thank you, everyone.